You know, if you look at the junior business worldwide, by the way, I'm going to make y'all sick before I make you well, so get ready. If you look at the junior industry worldwide, there's what, maybe 3,000 public companies? Something like that. You know, Australian, AIM, US, Vancouver, probably 3,000. And I would argue with you that probably 2,700 of them are valueless. If you merged every public junior in the world, one company now, Junior Explore Co., okay? You're merging all these petty dreadfuls into one company. This company in a very good year would lose $2 billion. In a bad year, it would lose $10 billion. So what should you pay for this company? Should you pay 8 times losses? 12 times losses? In a good market, you might pay 15 times losses for this company. The point is that most of this stuff is flotsam and jetsam. Most of it should not be owned under any circumstance. That fact obscures a fact that's much more relevant to you. 10 or 15% of the issuers in the junior market generate so much positive utility that they add legitimacy and sometimes even luster to a business that loses $2 billion a year. The game in speculation is to sort the wheat from the chaff. And that's where Vancouver comes in. The wheat and the chaff are both located here. You're competing against investors in Des Moines or Dusseldorf or someplace that's distal to where the value is created and where the risk is. Everyone that competes with you has to at least metaphorically come to Vancouver, and you have a huge advantage because you are already here. You have a disadvantage too, in that Vancouver has probably the greatest population of what would we call them, used money salesmen on the planet. People who are very skilled at narrative. People who will tell you a wonderful story about what gold's going to do, but they don't have any gold. So the point is that you need to be able to separate the wheat from the chaff, and you need to exercise the advantage that you have in Vancouver. How does that work? Life is about probabilities. It's not about certainties. Investing is about math. It's not about narrative. And so we're going to talk about that. And we're going to talk too a little bit more about your durable competitive advantage and how to use it. And I'm not going to talk about every commodity today. I just don't have time in 20 minutes. But I'm going to talk about an example of math in the context of the gold market. I realized that you would prefer it if I just said that gold's going to go to $20,000 or something and made a simple declarative statement. Everybody could clap and I could leave, but I'm not going to do that. Gold traditionally has done well during periods of time when people are concerned about the purchasing power of their savings in fiat-denominated savings instruments. And I'm going to make the case for you that people have reason to be afraid. And as they become afraid, they will become more gold-oriented. It's interesting, by the way, factoid. A lot of times people say to me now, Rick, when do you think the gold price is going to move? And I sort of sagely scratch my old chin. And I say, I think gold's going to move in the year 2000. Last 25 years, gold has moved from $250 an ounce to $2,700 an ounce. Gold is up, what, 8.3% compounded a year for 25 years? And these morons say, when is gold going to move? It's going to move over the last quarter century. I think it's going to move more going forward and faster, but that's a different question. People ignore the fact that gold has moved from $250 to $2,700 for some reason that's inexplicable to me. I guess it's the triumph of narrative over math. But let's get back to the math. Here's why an American should be concerned about gold. I don't have the same numbers for Canada, and I try not to insult governments in countries where I'm not resident, preferring to insult my own. Here's the math around US dollar debasement. At the federal level in the United States, we owe, on balance sheet, $36 trillion. You should write $36 trillion down just to see how big a number that is, because people's eyes glaze over when I use that number. $36 trillion. And that number, what we owe, grows by $2.5 trillion a year. Remember both of those numbers because they're going to become important. Because as bad as those two numbers are, it gets much worse. Really, truly, much worse. I'm smiling because the alternative is, suicide or something. The off-balance sheet liabilities of the U.S. government, the net present value of the off-balance sheet liabilities of the U.S. government, by the way, if you want to picture those, they're old folks. Medicare, Medicaid, Social Security, military pensions, federal pensions. That number, not according to some fat, bald old libertarian, that number, according to the Congressional Budget Office, exceeds $100 trillion. Net present value of off-balance sheet liabilities, unfunded, exceeds $100 trillion. So add 36 trillion, terrible number, to 100 trillion, a worse number, and you get $136 trillion. Sorry, we're gonna do some more math here. The Internal Revenue Service, funny how they call it a service, isn't it? Anyway, the Internal Revenue Service has suggested, and they would know this fact, that the net worth, aggregate net worth of American citizens, taxpayers, is $141 trillion. So here's the first math assignment. 141 trillion, which is what we're worth. 136 trillion, which is what we owe. Anybody want to tell me what's left over? $5 trillion. This is not narrative, this is arithmetic. And the inputs are not mine, they're the government's. But it gets worse. It gets worse. So the number is 141 on top, minus 136. Ugly sum, $5 trillion a year. It's a relevant sum for two reasons. Gross federal revenues in the United States before any expenditures happen to be $5 trillion. Happen to be $5 trillion. And if you add the sum of the increase in the deficit, which is that $2.5 trillion that we talked about before I made you sick, and you add to that the Congressional Budget Office estimate of the fact that the off-balance sheet liabilities of the U.S. government increased by $2.5 trillion a year. Trillion, billion, three zeros, what the hell, right? The number that you get is that this $136 trillion debt increases by $5 trillion a year. 5 trillion is a convenient number for the speech because 5 trillion is the sum that was left over when you subtracted 136 trillion from 141 trillion. Does this make any of you wonder how this might work out over time? I gave a speech similar to this, I don't know, a couple of months ago, and somebody said to me, Rick, it's been so for 20 years. That reminded me of the Hemingway talk. How does one go broke? Slowly, and then all of a sudden. The reason that I bring up all of this arithmetic, and the reason that I tie it back to gold, is it seems to me that there's two ways the United States has out of this problem. We could be honest, never done it before, but we could try. We could default. We could say to the bondholders, too bad, so sad, no money, strong letter to follow. We could say to folks like me, yeah, we realize you paid into Medicare, Medicaid, all that stuff all your life, but there's no dough left, you're not getting your money. Politically sort of challenging for the political class, So what I think happens is what happened in the decade of the 70s when we had a similar but less severe problem. What I think happens is that we honor the nominal value of these obligations by inflating away the net present value of the obligation. In other words, some old codger named Rick Rule who gets paid, I don't know what they pay me, $4,000 a month for my Social Security or something, they'll continue to pay it, just like they did in the decade of the 70s. But the spending power that they pay me with will fall substantially, which is to say $4,000 in nominal money will buy me $700 or $800 worth of goods. We did this once before in the US. In the decade of the 70s, and I can see in the audience, there's a few folks old enough to remember this like me. In the decade of the 70s, according to the Office of Management and Budget, over 10 years, the purchasing power of the US dollar declined by more than 75%. Again, this piece of math is not from a cranky old libertarian. It's from the Office of Management and Budget. Not coincidentally, I would suggest, in that same period, the gold price went from $35 to $850 an ounce. Do not quote Rick Rule as saying in the next 10 years that the gold price is going to go up tenfold. That's not what I said. What I did say was that I believe that the purchasing power of the US dollar will fall substantially. And it will fall at a rate that is substantially greater than the interest yield on savings products like the US 10-year Treasury. At the beginning of the talk, you remember I said, the gold price traditionally has done well when people are concerned about the maintenance of the purchasing power of their savings. And in that context, with $136 trillion in net present value of liabilities, I think that the arithmetic suggests that you need to be substantially concerned. I don't know what the similar numbers are in Canada. My suspicion is, on a per capita basis, they're probably worse, but I don't know that to be the case. But it doesn't matter in a sense. The US market is 24% of the world's savings and investment market. One more little piece of arithmetic before I go on to something else. Gold is way, way, way underowned. JP Morgan Chase says that the market share of precious metals and precious metals related investments in the US market is about 0.5%, which is to say 0.5% of savings and investment assets in the US market are comprised of precious metals and precious metal securities. We haven't needed them as investors for the last 40 years in the US. We've had other stuff to do. The 4-decade mean market share of these assets, and this is an estimate, JP Morgan Chase doesn't have the numbers, but it's an estimate. Their estimate of the 40-year mean is 2%. So I'm not going to be one of these crazy rabid gold bugs who says, you know, the US Treasury market's going to go to zero, the US dollar's going to blow up, the US economy's going to go away the dodo. It's not what I'm saying. I'm saying that we're going to have at least a reversion to mean. And if we have a reversion to mean, demand for precious metals and precious metals related assets, including penny dreadful gold mining stocks, quadruples. What do you think happens to price if demand quadruples? I think the increase is going to be pretty interesting. So I think that the case for gold isn't a narrative case. It's an arithmetic case. And I think it's an inescapable case.